One of the big objections for a fixed indexed annuity is that they're too expensive. But as I mentioned in my video on Mythbusters for a fixed indexed annuity, as compared to what? So mutual funds have a pretty high internal cost associated with them, and that doesn't include the annual fee that you'll pay to a financial advisor if that financial advisor is actively managing your diversified portfolio of stocks and bonds, which may include mutual funds. So in today's video, I'm going to give you a brief description of mutual funds, and then I'm going to show you how the costs are calculated on an actively managed account consisting of a portfolio of stocks, bonds, which may include mutual funds. Have you ever summed up the cost for your actively managed account to see how much they are? And do you understand how they're calculated? Well, let's see. Hi, my name is Darlene Hartman. I'm a CPA and founder of D. Hartman Consulting, LLC. For the best retirement annuity advice, subscribe to my YouTube channel and hit that notification bell so that you can receive notices anytime I post a new video. By definition, a mutual fund is a portfolio of stocks or bonds or other types of securities such as commodities, just to give you an example. So a mutual fund provides a small or individual investor the ability to access a diversified, professionally managed portfolio at a low price. And what I mean by that is since there's so many stocks and bonds and other securities in a mutual fund, you're not having to pay a trading commission for each one of those investments. Also, with a mutual fund, you have the ability to invest in companies that you wouldn't typically be able to invest in because their stock price is too high. For example, Amazon. So you would actually own an interest in a mutual fund that would own shares of Amazon, giving you the ability to reap the gains from a company such as Amazon. The advantages of a mutual fund can be classified into three broad categories. One is convenience, the fact that there are over 90 securities in one mutual fund, which are diversified around the fund strategy, which could be technology, it could be startup companies, it could be international, or it could even just be a large cap, just to name a few. The second would be diversification, the fact that you're not putting all your eggs in one basket, which will help to reduce risk and hopefully improve the performance of the mutual fund. The third one is the active professional management and the fact that the fund manager's intention for that mutual fund is to outperform the market. Now, as you know, intention doesn't always relate to the reality of the situation. Now let's talk about annuities versus mutual funds. So one of the big differences to note is that a mutual fund is actively managed, which means that the fund manager is constantly making decisions to buy and sell investments with the intention to outperform the market. Now, with respect to a fixed indexed annuity, it is passively managed. You do not own shares in the market index, but rather a portion of the market gain is credited to your fixed indexed annuity based on the interest crediting methods that are set up in your annuity contract. Another big difference to note would be the cost. So mutual funds carry an internal annual fee between 1% and 2%. So the fund manager will have to be paid for making those decisions about buying and selling stocks with the intention, again, of outperforming the market. But there's also administrative fees associated with a mutual fund. Now, with respect to a fixed indexed annuity, I've mentioned several times that in of itself, there's no upfront or annual fees for a fixed indexed annuity. Now, if you add an income rider, you will have an annual fee between 1 to 1.2%. The last difference that I want to talk about is the fact that mutual funds, the fund manager's performance could be short-lived. So you've heard the saying, out with the old, in with the new. So if a mutual fund is not performing well, then they're going to fire that fund manager and bring in a new one who can hopefully outperform the market. Now, the rating for a mutual fund, how you know if it's a good quality mutual fund, typically one of the factors is not only the performance of the mutual fund, but how long the fund manager has been managing the mutual fund. Now, with respect to a fixed indexed annuity, you want to look for the credit rating for the insurance carrier. So you want an excellent or even just a great rating, because that fixed indexed annuity may be around for quite some time, and you want an insurance carrier or an annuity carrier to be around for that long period of time. Keep in mind that an insurance carrier is rated by independent rating agencies such as Moody's, S&P, Fitch's, and AM Best. Leave me a comment in the section below and let me know if you've ever summed up the costs that you pay to your financial advisor for your actively managed account. Also, if you're enjoying this video, be sure to give me a thumbs up, subscribe to my YouTube channel, and hit that notification bell so that you can receive notices anytime I post a new video. So is a fixed indexed annuity expensive? And again, as compared to what? So right now we're actually going to look at the cost of an actively managed portfolio of stocks and bonds, which may include mutual funds. And I'm going to use historical returns over the last 20 years. And I assumed an annual cost to manage that portfolio, all inclusive, all cost, of about 1.5%. Wow, that annual fee totaled 42% of the initial investment of $250,000 made in 2001 and resulted in a reduction of the ending retirement portfolio balance of 25% at the end of 20 years. Also notice that you'll have to pay that 1.5% annual advisory fee even in the midst of market downturns. No exceptions. Now, the same is true if you're invested in a mutual fund. If that mutual fund is not performing well, you're still going to have to pay that 1 to 2% internal cost on that mutual fund. So in my previous video, I talked about the fact that if you're in the midst of market downturns, you're basically dug yourself a hole that you have to dig out of in future years. And in that analysis, in my previous video, I didn't even factor in costs. So now I'm telling you, you've got to pay those advisory fees or even those internal costs for a mutual fund, even if your market investments or your mutual funds specifically are not performing well. So now you're digging an even bigger hole that you've got to try to dig out of. And just as a reminder, because a fixed indexed annuity has a floor of 0%, you're not digging yourself out of a hole. Now, this is worth repeating. A fixed indexed annuity in of itself has no upfront or annual charges. Those annual charges are actually associated with the income rider that is added to your fixed indexed annuity at a cost between 1 to 1.2% per year. Now, I don't want you to forget what you're solving for with this fixed indexed annuity with an income rider. It would be the guaranteed income benefit that you're going to get, and that peace of mind knowing that you're going to get that guaranteed income benefit over the remainder of your retirement if it's lifetime income annuity. It's always good to look at all of your options. So if you can get that guaranteed income benefit pretty high with a SPIA or a DIA as compared to a fixed indexed annuity, then why incur that annual fee for an income rider on a fixed indexed annuity? So right now, I will say that fixed indexed annuities are performing better than the SPIA and the DIA because we are at a historically low interest rate environment. If you're interested in obtaining a fixed indexed annuity for your retirement portfolio for the guaranteed income benefits it can provide you, click the link below to apply to become my client. Also, if you enjoyed this video, be sure to subscribe to my channel, give me a thumbs up, share it with your family and friends. Thank you for watching. Let's get the conversation started on how you can live your best retirement while not outliving your money.